Hello, if you're watching this, this is a pre-qualification for an investor who is buying an apartment complex that is stabilized. So what we're going to be doing today is walking you through our model to get an understanding of how to pre-qualify a property for you as the borrower and to know all of the specific things about the property that the lender is going to be looking for, as well as from you individually, and just give you a sense of terms and expectations when you're borrowing money for an apartment complex. So let's start up top here with the actual financial model that you'll be plugging in. So the very first thing you'll do is to obtain what are the gross rents for the apartment complex. You can get this from a profit and loss that's given to you. You can obtain it from a rent roll to show what is in-place income on an annualized basis. One of the things to be cognizant of is that the lender will not really take pro forma income. They want to know what is the in-place income that they're actually receiving. Next, you'll more than likely on apartment complex find a category for other income. This could be laundry income, it could be parking income, something that is regular, it's consistent, it's not just scattered income. For example, fees wouldn't be really considered from a lender's perspective in the category of other income. Pet fees could possibly fit in there, but just try to think of the income outside of just traditional rents that will be ongoing and consistent. What will happen is that'll generate what's called an effective gross income, which is basically totaling up all of these categories, the 100 plus the 5,000. The next in line, which is the vacancy factor, and also understand that everything in yellow is automatically being calculated. Everything in white, you will plug in yourself. The vacancy factor, we're going to just use 5%. Could be different. You might want to know what your local vacancy factor is. A commercial broker might be able to help you with that. So the vacancy factor we're using is 5%. So you could change that number and it will adjust here in this section. The final number at the top line is gross revenue. This is, again, your effective gross income minus the vacancy factor to give you the tangible gross revenue that's available. And remember that an appraiser is always going to use a vacancy factor to some degree because market always has some level of vacancy over time. Next, we're going to go down to the expense category. As you go down the line, feel free to plug in any of the expenses that will line up with whatever is given to you in the profit and loss statement from the apartment complex you're looking at. But a couple of categories just to be aware of. So management fee, if there's nothing on there, you definitely need to make sure to put it on there because the lender will. And typically they're going to use 4% of your gross revenue. So that's just a quick calculation you could put in there. They might have HOA fees, possibly not, if it's a part of an association. Property tax, definitely make sure that that is a category that's in there and that you have a full fiscal year worth of taxes. Might even want to be aware of what are the future taxes that are going to take place for this as well. Insurance, the actual physical property and casualty insurance. If there's any additional insurance for that particular local geographic region, you would want to know what is that and plug that number again on an annualized basis. Utilities. Many times if this is a individually metered property, you won't be responsible, but if there are vacant units, then there might be some spillover that you are responsible for as the owner of the property. So make sure you understand what is the situation for the utilities. Repair and maintenance, traditional just ongoing paint, deferred maintenance, could be some cracking, carpet, just again, regular ongoing deferred maintenance is what this category will be, versus an all-out repair could be a whole HVAC unit or repairing the roof or redoing the parking. That's more of a capital expenditure item that will go down below the net operating income. General and administration, this is legal, accounting, anything that's just administrative in nature, phones, things of that magnitude. You'll want to make sure that that is implemented. Advertising, how do you market the property? Is it yellow pages? Is it online? Websites and such, so make sure that you understand that. Payroll, is there somebody that's actually on staff? Could be perhaps a maintenance man who is utilizing or doing something along those lines. And then we just leave these expense items in here for you to fill in. If there's any additional expenses that are on their profit and loss statement, make sure to just fill it in and put in the annualized number. You'll notice over here that these calculations, they just give sort of a ratio off of the gross revenue that just gives you some numbers to compare. They're basically, call it 4% is right here, or 0.04. This is 1% of that, 10% and such, just to give you an idea. As we go down, this will total up the total expenses, and it'll give you again a percentage. This is 30% or 29.56% of, again, the gross revenue to give you a frame of reference. The net operating income, again, this number right here is the gross revenue minus the total operating expenses, gives you the net operating income for the property prior to taking out any additional reserves prior to paying the debts. You'll notice a couple of items here. I don't want you to worry about these two for apartments. It's more applicable to commercial office or retail or industrial. But the one thing you do want to focus on, that most lenders will look at to some degree, is what's called a per door replacement. This is ongoing maintenance that would take place in order to prepare yourself for these additional expenses. This is above and beyond traditional ongoing operating expenses, but again, could be things such as a full renovation of a kitchen. It could be things such as the repaving of the parking, the redoing of HVAC units and such. So what we'll use, and as you put your mouse over it, this will actually pop up a little note here, which will say use $250 per door per year. And this will automatically calculate that 250 multiplied by the total units you put in here of how many apartment units to give you an expense number. And then what will happen is when you put that in and it's calculated, it will adjust this final number, which is your net cash flow. And the net cash flow is probably one of the most important numbers because this tells you what is available for the property on an annualized basis to pay for the debt service that you're going to borrow, whether it's 70% or 75% of the total purchase price. What is available to make the payments for that property? So very critical number here, and it'll manifest as we go down. So again, total units, you'll just plug in here how many there are. Could be 12 or whatever that is. This number down here calculates your expenses per door. So again, remember the expenses were $29,490. That is divided by 12 to give you the expenses per door on an annualized basis. And just to give you a frame of reference, most lenders are going to use a bare minimum of $2,500 to possibly 3,500. Some of this depends on if it's master metered or individually metered. We'll talk about that later. But if you see anything around 1,500 or 2,000, that could be too low, just as an FYI. The capitalization rate, this number is sort of telling you exactly what you're paying for the property as a percentage of the purchase price based upon your net cash flow. So if you're buying it all cash, call it $1 million, or which is the valuation, you'd be getting a 6.5% return on your money. Capitalization rates really take into account the location. They take into account the condition of the property, the geographic market. A lot of different variables go into play, and the market usually dictates what that will be. And it's really a function of supply and demand. So if you're buying a property that's in a major metropolitan area and it has great occupancy and it's new, chances are you're going to pay a lower cap rate because you're getting a lower risk property, which means you're getting a lower return, versus if you're in a tertiary or submarket and you are paying for something that might be a little dilapidated. That number actually may be a little bit higher because you're taking on more risk, hence you need a higher return. Down here you'll put in the total square footage of the apartment complex. What'll happen is this number, a price per square foot, tells you the valuation divided by the square footage to give you a price per foot, just as a frame of reference. To see how that compares to other properties. The value per door, again, this actually takes the 1,080,923 valuation number and divides it by the total units. So again, they would be paying $90,000 per unit for this property. Expenses per square foot, again, this takes the total expenses up here, divides it by the total square footage to give you an expense per foot for that property. Valuation actually takes the net cash flow, it divides it by the cap rate to give you the valuation. So think in terms of the lower this number, the higher this will be, all other things being equal, meaning this stays the same. As this moves up, so if it was 7.5, 8.5, then this number will start to go down. So there is a sort of a negative correlation between the two. Here you'll put in the loan to value, what the lender is willing to lend you based upon a loan to value, just as a frame of reference. Apartment complexes, the max typically is 75. Sometimes you'll see 80, but that's rare. So 70 to 75 is a pretty safe number. More 70 is probably safer than 75. Loan amount, this will automatically calculate based upon the valuation multiplied by the LTV. Rents per foot will take the total revenue, gross rents, divided by the square footage right here to give you what you're getting on average for that location. You can put an interest rate in here. We just use 5%, could be a little lower. 25-year amortization, a lot of times it could be 30. And this will automatically calculate your annual payment of principal and interest. And then the final number, which again is a very critical number, is what's called the debt service coverage ratio. And what happens is this actually takes your net cash flow and it divides it by your outgoing payment on an annualized basis to give you a 1.31 debt service coverage ratio. What is that? Well, it's basically gives the lender an idea that after all your expenses, you have this net number could cover the debt payments 30% above break even. So as opposed to this being the same number as this, it would be break even. There's some cushion. There's about 30% cushion there, 31% cushion, the 0.31 above break even. And lenders typically like to see a 1.2 to 1.3 times. So if it starts to go lower, like 1.15 or 1.1, that's probably not a good sign. Okay. Now let's go up here and talk about this section, which is really the property pros and the property problems. We went ahead and put together just some things to be cognizant of when you're trying to qualify a property. The first one for apartment is the property visually appealing versus is it beat up or run down? That's a big deal to the lender and should be to you as well. I mean, how does it look? Dilapidated and such, that's one thing that could be a factor in you getting approved. The other thing is the property individually metered versus master metered. And you say, what is this? Well, when you're acquiring an apartment complex, a lot of the older properties could be master metered, which means that everything goes to one meter as opposed to the individuals in the units paying for their own utility bill. It actually comes to you as a large expense, and typically you're the one that is stuck with paying the utilities. It's typically unfavored from the lender's perspective because there's just very little accountability for the tenant to keep their power down, as opposed to if they were the ones paying the expense. So that can be a factor as well for getting approved. The other one is the property in a major city versus a small town. Again, lenders like to be where there's more people, where it's higher demand for that versus a small town is typically makes it a little bit trickier to get approved. Property is at least 85% occupied or very vacant. Generally speaking, for apartment complexes, 85% is a good number. 90, 95. If it starts to go lower, 70, 75, that gets real tricky. The property has at least 1 year leases signed, maybe 6 month is a good rule of thumb. The property has a lot of month to month. That could be a negative sign for a lender as well. The property has several years of history versus it's brand new or less than 1 year. Lenders like to see that it's been stabilized and paying and operating. The property has copies of the leases versus a property does not have leases. That could be a big problem if they don't have records of the actual leases that they signed. Could be a huge issue in getting a property. The property has good books and records versus not. Do they have good P&Ls with the detailed? Is it been done in QuickBooks or something of the like, or is it just chicken scratch? Is somebody just throwing some stuff together? It's always helpful to have actual tax returns because now you know that they've actually filed them and to the IRS, so just it solidifies it more. The property has good-sized units and bedrooms versus very small units. Again, this could be a factor that comes into play, but just something to be aware of as you're utilizing that. The property is in high demand area. Is there a high demand for this? That will be really manifested, so to speak, in the occupancy and such. But just, is there high demand? Is it low demand area? So again, those are just some items to look at when you're sizing up a property. Let's go down to the borrower pros and the borrower problems. So the borrower has relevant experience versus little to no experience. Have you done this before? Is this your first time? Lenders look at that. They want to know that you actually have some seasoning or history to buying a property. The borrower has good outside income versus the borrower has little or no outside income. Again, is this going to be your sole cash flow source, or do you have multiple sources, or do you have a job? They like to see that just to have a secondary source of repayment is what they typically utilize. The borrower has good cash reserves versus little cash reserves. Pretty simple there. Do you have some money set aside in case things go south or a rainy day? The borrower has good credit versus bad. And what does that mean? It really depends. It's, do you have, 650, 700 FICO? If you had a bankruptcy, foreclosure, short sale, anything along those lines that are recent could be an issue for some lenders, so we want to be aware of that. The borrower has reasonable levels of debt versus very highly leveraged. Have you borrowed tons of credit cards? Are you, maxed to the hilt? They'll definitely size that up. Just gives you an idea of, how the lender's going to look at it, and to be aware of it. And then finally, just some terms and expectations in general here. Again, they're going to use a 25 to 30-year amortization to calculate the payments. You could fix it for 3, 5, 7, 10, even 15 years. There have been instances if you're getting what's called an FHA 221D4, it could be 25, even 40 years. But typically speaking, it's usually 5, 7, 10 years for the fixed period. Rates can be in the 4s right now, could be 4.5 for 7 years, could be 4.5s in the 10s. This is subject to change based upon the market. Fees to expect 1 to 2% in originations. Appraisal could run you $3,000 to $5,000 for closing costs. Phase 1 could run $2,000 to $3,000. This is to check and make sure there's no sort of contamination or asbestos on the property. Legal costs, again, it could be nothing depending on the lender. It could be up to $10,000, $20,000, and this is really subject to the type of lender and the type of loan and the size of the property as well. PCA is what's called a Property Condition Assessment Report. This is just a sort of an engineering report on the property, and it runs anywhere from $2,500 to $3,500. ALTA survey is, again, an ALTA survey to look at the meets and bounds, the property boundaries. A lot of times the actual title company will demand this, and it could be 2,000-ish I put here. Titles, anywhere from 3,000 to 10,000. This is really a sort of county or local jurisdiction driver. Texas can be really expensive. New Mexico can as well. Max LTV, again, like I told you earlier, 75, 80% is really probably a push, but from time to time. Lender types for these: Fannie, Freddie, banks, CMBS, which are commercial mortgage-backed securities. Those are tough. Life companies are good lenders. Prepayment could be none, step down, which is like a 5, 4, 3, 2, 1, or yield maintenance, which gets sort of tricky. That can be on a different video as well. Closing time frames is 45 to 70 days. So again, this is just how to size up a property, pros and cons, some of the issues you might run into from the lender's perspective. And hopefully this was helpful for you in identifying how to pre-qual a property. Thank you very much for listening to Integrity Capital.